Hi everyone, welcome to the Real Estate Tax Tips channel. My name is Cherry Chen, a chartered professional accountant based out of Oakville, Ontario, Canada. Today we're going to talk about short-term rental tax implication. Now before I get too much into depth, every week I send out an email about money saving tips and real estate tax tips, all designed to help you build your long-term wealth and live life on your terms. The email takes 5 minutes to read and over 10,000 Canadians get it. Think you'll like it. Sign up using the link below. A lot of real estate investors love doing Airbnb or short-term rentals. A lot of people don't understand the tax implication that carry with operating a short-term rental. And today we're going to go into depth in terms of the HST implication as well as the income tax implication. Now with that, let's start with HST implication. HST implication on rental income that you've collected from short-term rental. If you operate short-term rental is less than 30 days, the short-term rental income is considered commercial activities in the eyes of the Excise Tax Act. What it means is that when something is considered as commercial activities, what it means is that you would have to charge HST on your rent if you rent out your property short-term, fewer than 30 days. There is a small exception to it. There is a small supply exemption available if your revenue from your short-term rental and all other income from all other commercial activity that you may also operate on an associated basis is less than $30,000 in a 12-month period. Now let me explain. If you operate your short-term rental and your short-term rental generates about $20,000 of income, but you also have a side business that drives also for Uber Eats, and that also generates an additional $20,000 of income. The combine of two would be $40,000, and you would be over the small supplier rule, and you would then have to charge HST. Just because your rental income from your short-term rental is not over $30,000 does not mean that you don't necessarily have an HST implication. Now, HST implication on purchases. If you're buying a newly constructed home for Airbnb purpose, for short-term rental purpose, you may want to consider volunteering to register for HST before waiting for the short-term rental income exceed that $30,000 small supplier rule. The reason being is that you can purchase a new home without paying for HST if you're using it to earn income from commercial activities. That's no different than me buying my office and I am using the office space to generate my accounting income, which is considered commercial activities in the eyes of the Excise Tax Act. So when I purchase the property for commercial purpose, I don't need to pay HST. I get HST exempted, because I would eventually be able to claim it back, offset against the HST that I charge against my client. Now, this means that you will have to charge HST even if your revenue is below $30,000. At the beginning, during the setup period, you may not hit that $30,000 threshold. If you volunteer to register for HST at the very beginning to purchase a newly constructed home for the use of short-term rental, you would still need to charge HST even if your rental revenue in the initial period is less than $30,000. Now, let's talk about HST implication if you decide to stop the Airbnb operation, decide to stop the short-term rental operation, and switch it to long-term rental or personal use. Well, if you decide to get out of this whole short-term rental game with your particular property that you've always rented it out for short-term rental, turn it into either long-term residential rental or personal use after operating your property primarily as short-term rental. You're now considered to convert this commercial property because the property was commercial. You're collecting rent in a commercial sense that you have to collect HST on behalf of the government. So the property that you're earning income from is considered commercial property. Now, if you were to convert it from a short-term rental to a long-term rental, long-term residential rental, or you're converting it to personal use, these are activities that are exempted from Excise Tax Act. You don't have to charge HST. But it also means that you are also converting a commercial property to a residential property. When you're converting a commercial property to a residential property, when you do the conversion, you're required to self-assess the HST on fair market value of the property at the time of the conversion, remit the HST to CLA. So what does that really mean? Say you purchase a residential resale property for $500,000. You set it up as a short-term rental, you furnish it, and you rent it out. You didn't pay any HST on the purchase. You decide to use this property for short-term rental purpose to generate revenue for a couple of years. COVID hit and you're forced to pivot and converted the entire property to a long-term rental instead. At the time of the switch, the property was worth $600,000. Now you would have to do a self-assessment on HST, remit HST on $600,000 to CLA as you are converting a commercial property to residential use property. So 13% of $600,000 is $78,000. You're eligible to claim HST that you pay on acquiring the property, which would have been minimal because it was a residential resale home. You didn't pay HST on the purchase, so you would have to remit most of the $78,000 to CLA. Ouch, that's a lot of money. What if you decide to sell the property as short-term rental instead? This means that when you sell your property, you would have to charge HST on the sale of the property. This is actually very common for properties that are primarily used as short-term rentals in the resort-based rental area. A lot of them are surrounding the ski hills in BC. A lot of them are used as short-term rentals. So when they got sold, the seller actually asked for GST being charged in BC. Now, in other markets though, it is unusual for the sellers to sell a residential resale home and charge HST on top of the market price. If it isn't receptive in your particular market, depending on where your short-term rental is, unfortunately, you will have to include HST in the sale price. And again, similar to the example I used earlier, if you purchase a residential home for $500,000 and used it for a short-term rental, later on sold it for $600,000, the $600,000 would have included the HST and you're liable to do a self-assessment to CLA. Sucks. So you may wonder, as short-term rental investor, are there ways out to avoid paying HST on the conversion from a commercially operated rental to a long-term rental? Or if there is any way to avoid paying the HST on converting your commercially operated business on the sale at the time of sale? Well, CLA evaluates whether a property is used as a commercial property or a residential complex, which is not subject to HST, based on this thing called time-based calculation. So it goes back to how often and how many leases that you have that are short-term rental as compared to long-term rental. You have signed a lease with someone that would occupy the entire property for 4 months, as in the case of my friend who has a cottage somewhere up north and it is a popular location. If you have a long-term lease, they would look at your long-term lease number of days available for long-term lease and compare that to the number of days it is leased out as short-term rental and do a calculation and see if you are using it substantially for the purpose of short-term rental or long-term rental. And you may have an out in terms of whether you would be eligible to get exempted to do the HST self-assessment at the sale of the short-term rental to regular residential home. Now that we've talked about the tax implication from an HST perspective, it's time to talk about the tax implication from an income tax perspective. Yes, we got lots of taxes that we have to pay. So from the income tax perspective, if you own the property, your short-term rental in personal name, you can report your short-term rental income as rental income, regular rental income on the schedule of T776, Statement of Real Estate Rental, or you can report it as self-employed income, depending on the extent of service that you are providing. If you're operating the short-term rental as a business, providing a lot of services similar to what a hotel would normally provide, you can choose to report your short-term rental income as self-employed income. Now, the net result on your personal tax return is very similar. You're being taxed on the same amount of dollars, same amount of income, whether you're reporting it as rental income or self-employed income. The only difference is that when you report your short-term rental income as rental income, the net income you get is not subject to Canada Pension Plan, Whereas if you report your short-term rental income as self-employed income, you're liable to pay both employer and employee portion of Canada Pension Plan, which could be as much as $7,000. Now, from a financing perspective, you are eligible to borrow money using your self-employed income. If you have a substantial amount of Airbnb income reported on your personal tax return, it may actually help you with financing. But if you were to report those short-term rental income on your Schedule 776 as your rental income, the calculation for mortgage qualification can be slightly different. A lot of the time, the lenders, the banks out there would only count half of the rental income for your mortgage qualification. So it's not as beneficial to report these short-term rental income as rental income on your personal tax return. If you operate the short-term rental in your corporation, depending on the extent of service that you are providing, you may have an argument to report your rental income as active business income, which you will only pay 12.2% tax in Ontario. However, you need to provide strong documentation on your situation as to why your short-term rental is providing similar services as a hotel operation would provide. This can range from providing cleaning services, internet services, local theme park passes, being fully furnished, linen service, sauces and spice, olive oil, you name it. Anything above and beyond to show that you are no longer just a regular basic rental, but a service-based business. Now, on the flip side, you can always report your rental income as passive income, just like the income from your long-term rental. The downside of this is that you will be subject to 50% passive income tax rate inside the corporation, although out of that, 30% would be refundable when you declare a taxable dividend. You do have the option to pay yourself a salary to lower the amount that is subject to the higher rate. Final question. What if you do rental arbitrage? First of all, what is rental arbitrage? Essentially, rental arbitrage means that you don't own the short-term rental yourself. You rent a place from a landlord that's willing to allow you to operate a short-term rental at that location. In exchange, you pay the landlord monthly rent. The Hsd implication on rental income from short-term rental is the same as what I mentioned above. You have to charge Hsd on rent if your income from all commercial activities, including short-term rentals, exceed that $30,000 small supplier rule. You can claim the Hsd you pay on expenses such as utilities, repairs, maintenance, advertising, etc. to lower the Hsd payable. You can claim the rents that you pay to the landlord as business expense. If you operate a rental arbitrage business in your personal name, I would report the income on the self-employment schedule as you are truly operating a business here because you're leveraging the two. If you operate this business in a corporation, again, depending on the amount of services you are providing to the guests, you may have a stronger argument to report your income as active business income. Now that we have covered all the tax implication, including Hsd implication and income tax implication on operating a short-term rental, I hope you find this video useful. If you like it, make sure you hit the like button at the bottom of this video. And if you are operating a short-term rental and have all these ideas on how to make sure that you are paying as little tax as possible, if you have any questions, make sure you leave them on the comment section below. Until next time, thank you for watching.